Podcast with our host, Ed Lyon. Ed, another amazing guest you have today.
Another amazing guest, and this is a slightly different direction than we've taken on any of our previous conversations. So we talk a lot about tax planning versus tax preparation. We talk a lot about how to think about tax planning, but we really haven't spent a lot of time talking about specific strategies. And it's ironic that I'm kicking off this discussion of a strategy with something that is not a tax strategy.
That's right.
So our guest today is Randy Sadler. He is a partner with CIC Services. They are a captive manager, and we're going to talk about captive insurance. The irony is that captive insurance is a risk management strategy first and foremost. There are tax benefits to captive insurance, but if it doesn't pass the test as a risk management strategy, it's going to fail as a tax strategy as well. So, Randy, you are a West Point graduate. You are a former tank commander, I believe.
It's true. Yes, that's right.
And tell us about the journey that took you from commanding a tank to wearing a coat and tie and talking about risk management with some of the biggest business owners in the country.
Oh, wow. Okay, that's quite how long do you want me to spend on that? I'll make it brief. How's that? Yeah, so very good. Yeah, so I did go to the U.S. Military Academy at West Point, but what I will say in parallel is I bought my first rental house when I was a junior, essentially in college or at West Point. So had an idea from watching my father that real estate was a great place to make an investment, use leverage, and importantly, properly run real estate has some nice tax advantages, right? So depreciation, interest write-offs, even did a few 1031 exchanges, not when I was in college, but later, right? So initially got interested in tax strategy at a very young age. And then after working in the Army for 5 years as a tank commander, I worked a few Fortune 50 stints. One of those in your hometown, Ed, Procter Gamble, right there in lovely Cincinnati, Ohio.
About 3 blocks away from where I am.
There we go. Right. Yeah. Great place to work. And so I really felt like at P&G, I really kind of learned call it an MBA, if you will, not a true MBA, but sort of felt like one. And then really forayed from there through several corporate roles. But then a good friend of mine, Sean King, who I went to high school with, believe it or not, founded.
I always wondered where that connection was.
Yeah. Well, Sean is a genius, and it's always good to know a few geniuses. That's why I like to hang out with you, Ed. But
I was just going to say, that's why I like to hang out with you. I don't know many geniuses.
But Sean is one of those guys that was always a step ahead. So he got his attorney CPA at UT while I was banging around in tanks. I think he probably made a smarter choice than I did. And so Sean got into retirement planning right before it became cool, and then rode that, and then got into captive insurance, which we're going to talk about, before it became cool, and then got into cryptocurrency before it became cool. So he's just always a step ahead. And I was fortunate enough that he asked me to come on board at CIC Services. CIC Services manages captive insurance companies, which is effectively we help business owners own their own insurance company. And we'll go into a lot more detail, I'm sure. But it was really, I think Sean saw that I had a fascination with tax strategy. Was in addition to always having, really, really exciting work in sales and marketing, I also owned investment real estate, some other side businesses, and was very well acquainted with tax and how those structures work. So I think that's one of the reasons that he really wanted me to come on board. And I've been here 13 years. And when I started here, we were managing 35 insurance companies for business owners, and now we're managing 200. So, quite a bit of scaling over those years.
Sure. So you said that captive insurance essentially lets a business own its own insurance company. There are more insurance companies than I can count. You've got Flo at Progressive, you've got Jake from State Farm, you've got Mayhem from Allstate, you've got the Professor from Farmers Insurance, and of course you've got the Geico Gecko. Why would a business owner want to own their own insurance company?
Oh, that's a great question. So, there's really 3 reasons, okay, and I'll hit them one at a time. The first is you're paying too much for insurance, or you feel like you are, and there's a whole lot of variables around that. Could be you had a claim and they didn't pay. Could be you're paying too much, and it could be that, you haven't had losses, but you're getting rate hikes, right? And many of my clients are in the heartland, if you will, And if you are in the heartland, guess what? You're probably paying for the coasts, so
Right.
a property owner in Ohio, for example, where you are, is paying for somebody in Florida to get a hurricane hit them, right? So that's the first reason. Okay. The second reason is asset protection. So by owning an insurance company, a business owner is able to move money into an asset protected vehicle, very difficult for a creditor to attach to because they don't have standing. And that's because that insurance company is licensed by a state department of insurance who's not going to just let some creditor waltz in and take it. So that's a huge benefit. And the final benefit, of course, is taxation, right? So, Ed, you're in one of my favorite cities. If you drive over that hill in northern Kentucky and you see that Cincinnati skyline, such gorgeous buildings, and quite a few of them are insurance companies, and you might ask why. Well, all insurance companies are able to receive in premiums, reserve it for future losses, not pay taxes on it for a while, that's called deferral, and then eventually, when they can't justify those reserves after paying claims and investing this money, by the way, that hasn't been taxed, they're eventually taxed at C Corp rates, 21%. Warren Buffett, for example, uses his insurance companies, Geico being a key one, to have float and to take advantage of the tax benefits of insurance. Now, there is one more benefit.
Yeah, I think a lot of people in America don't understand just how much money the insurance companies are in control of. In most cities in America, the tallest building downtown has an insurance company's name at the top. Here in Cincinnati, 3 blocks away, there's Great American Insurance, and I can look out my window and I can look into Great American Ballpark.
That's right.
So Prudential has over $1 trillion in reserves.
They do. And it's a lot easier to build to $1 trillion when you're investing money that hasn't been taxed. So So that's the key. So the final thing I was going to say is a small, mid-sized business actually can elect to be taxed under what's called 831B. 831B is in the Internal Revenue Code. It was actually created in 1986. So this thing is going on 40 years old, and it allows small, mid-sized businesses that own an insurance company to actually have their profit taxed at zero. And so that was designed to help small and mid-sized businesses self-insure. I would be remiss if I didn't mention the IRS does scrutinize that closely. And so
the IRS does not like Code Section 831B.
No, they don't. So we need to follow what Ed said at the beginning of the podcast to remember that this is a risk management strategy that has tax benefits, not a tax strategy that has risk management benefits. And it's very important to get that order correct. Yes.
So let's talk a little bit more about risk management. I'm a surgeon. I operate on brains all day, and then I get in my car and I drive to my house at night. Do I want to set up my own insurance company for my malpractice insurance, my car, and my house? Is that what I'm doing?
Well, it's certainly possible to do that. Harder for the car because the state has a lot of requirements when you drive on their roads. Okay, we do insure medical malpractice for physicians, although usually it's for a whole group, not just one or two individually. However, many times we don't really think about the risks we really face and what would really put us out of business, right? So think about for a surgeon, they may have a long-term disability policy, right, which maybe pays them half their income for the rest of their life, but they can never practice again, right? Well, what about a short-term disability policy, right? What if you get hurt and you can't make money for 6 months? Your long-term disability is not going to pay. None of your other insurance is going to pay. So now you have a tough decision. Do you let your office staff go? Do you stop paying your rent? Or do you have a captive insuring you for short-term disability, right? So that would be one example of a huge risk.
This is the business expenses of a short-term disability, not just the personal family expenses, okay?
Correct. Yeah, that's exactly right.
I'm fascinated by some of the coverages that I've seen. Years ago, 20 years ago, had a guy who owned a deer farm in Ohio, and he bred deer. They were genetically modified to have big antlers, so they'd look manlier on the wall in your man cave. And the deer went out, the deer ended up on farms in Texas and Wyoming, and rich guys would go out and shoot them to have the big Hordes. Well, where Jake from State Farm doesn't have deer herd insurance coverage,
Oh, no, no,
and he's not ever going to.
no. No, and it's interesting you say that because one of our largest clients, they're not insuring deer. That would be kind of cool, but they are insuring livestock mortality, right? And so, if you have a lot of animals and disease or something could come and ravage your livestock, that could completely wipe out your business. Absolutely.
Sure.
So yeah, that's a good point.
Ed, because I've learned a little bit about captive insurance on interviewing a lot of different people in the last couple of years. My question is, I'm always hearing it as a tax strategy. So this is the first time ever I'm hearing it is not. It shouldn't be just based on a tax strategy.
No, you can't go in, and that's where the IRS is going to look at you. So we can talk a little bit more about this as the call goes on. But if you're a business owner making, say, $3 million a year, and you want to create an insurance company and move $500,000 in premium from your company to your insurance company, you'll be able to deduct the $500,000 at the company level, and the insurance company doesn't pay tax on it. Now, think about that for more than about 3 seconds, and you say, wow, that is a boondoggle.
Yes.
I want to do that all day, every day. But if you're going to take a deduction for insurance premiums, this is where the magic happens. When you deduct those insurance premiums, it's got to be real insurance. And the IRS is going to look, and they're going to say, look, this is your own fly-by-night insurance company. There's no real risk sharing. There's no real insurance coverage. You're calling it an insurance premium, but it isn't really. And the IRS can disallow that deduction. Usually it's going to take years of audits and court cases before you get to that point. So not only are you going to owe the tax, you're going to owe interest, you're going to owe penalties. And about 20 years ago, it was really abused. So there was one famous case, and Randy, correct me if I get the details wrong, but this was a jewelry store in, was it Phoenix or Tucson? Somewhere in Arizona.
Yeah, somewhere in Arizona, yeah.
A jewelry store somewhere in Arizona, and they set up a captive insurance company, and they bought a policy for terrorism insurance. And the premium was $300,000 a year for terrorism insurance for a jewelry store in Arizona. And that just doesn't pass the smell test.
It does not.
It doesn't. And so the IRS is going to look at that, and they're going to call BS. And then the owner of the insurance company is going to appeal to the tax court, and the tax court is going to say, no, the IRS was right, this was BS. And you're going to go all the way up through the courts, and every court is going to say, come on, are you kidding? So it's got to be real insurance. It's okay to be motivated in part by tax savings.
Uh-huh.
Absolutely okay, but it's got to be real insurance. So of the 3 reasons that Randy gave us, one, you can pay less for your insurance through your own company if you're not cutting in Jake from State Farm for a piece of the premium.
Yes, good point.
Or you can buy insurance that you can't get from Jake. So
Yep.
Kidnap and ransom insurance. If you're a pawn shop owner and you routinely carry gold in large amounts of cash, and you go to Jake and you say, I'm worried that I might get kidnapped. Can you insure this? Jake's going to, sorry, man, I can't do that.
Or it's going to cost so much, it's not worth it. Yeah.
Right.
Yeah.
Right. So you've got to meet the first requirement, and then you'll get the second, the advantage of the asset protection, and you'll get the advantage of the tax savings. But it's got to be real bona fide insurance. It's got to be able to pass the smell test. You need independent actuaries and underwriters, and it's got to be the real deal.
Absolutely. Couldn't agree more.
So, yeah, the IRS is looking hard. And tell me where the IRS is. It strikes me, and you're in the middle of this, that the every time the tax court tells a captive owner you can't do this, the reputable captive managers say, okay, great. Now we know what we can do. Now we know what they did wrong. We know how to fix that problem. What's your take on IRS attacks on 831B? And then let's talk about the listed transaction and your case in the Supreme Court.
Yeah, very, very good question. So, yeah, I think I'd preface my comments by saying exactly what you said. It's very important that a business owner form a captive to ensure legitimate risk, protect their business. And very often, by the way, we are replacing insurance they're already buying, which would be very hard for the IRS to argue that's not real insurance. And very often we insure warranties through captives, which again, very difficult for the IRS to challenge warranty programs. And
I have not met a car dealership owner who doesn't have a warranty company.
That's correct. And they have never been challenged as far as I know. I can't think of a court case where they did, right? And then whenever we can, we like to put health insurance in captives. One, it helps lower health insurance costs for businesses, and two, it makes them far more defensible. As you can imagine, right? If you're insuring health insurance in your captive, it's going to be far more defensible. So focus on good risk management.
Terrorism, you're only going to have one claim.
Yeah.
And you're probably not going to have that claim. But if you're insuring part of your employee benefits, through that company,
that's right.
There's real insurance company activity.
Yep, there's churn, all that good stuff. Exactly. So I think you raise a very interesting question, which is, what's our perspective on the IRS at this time? And I'll give you a very quick rundown on it. So first of all, 831B is in the tax code. It's been in the tax code 40 years. And no one disputes that it's real law, right? Nevertheless, the IRS, if they're going to attack your insurance company, they're going to do exactly what Ed said, which is attack your motive. They're going to try to prove that you only formed your captive insurance company for tax benefits. You had no insurance benefits in mind. For that reason, we believe it's very important that business owners and their advisors, that would be either their tax advisors or their property casualty insurance broker, approach the captive from a standpoint of how is it going to make sure the business survives. And that's a pretty broad question, right? There's many risks that businesses face. Some they're insured for commercially, many they're not, like reputation risk, supply chain, for example.
There's somebody in the Epstein files must have captive insurance for reputation risk. We saw just this morning, Bill Gates admitted to having affairs with 2 Russian women while he was married. Apparently there was an Epstein connection. I think the odds that Epstein was not blackmailing Bill Gates are pretty short. And I'm not a conspiracy theory guy, but if your name is in the Epstein files, all that's wrong.
Yeah, you got a challenge on your hands, right? But I'll give you, one that's been pretty common for us, frankly, has been tariffs, right? So many of our clients have regulatory legislative change coverage in their captive, and when they've been hit with tariffs under the Trump administration, those tariffs have affected them because they're selling at one price and now they're sourcing at a higher price. Sure. And even though you might think you can pass it through, you may not be able to pass all of it through or pass it through quick enough to the consumer. And maybe one of your competitors is sourcing somewhere that has a lower tariff, so you're at a competitive disadvantage. Okay. Many of our clients that have captives received relief for tariffs. So that would be a classic example. So that's kind of part one, is really focused on insurance benefits. Yeah. Now the second thing, go ahead, I'm sorry.
I was going to say COVID.
COVID's a classic example.
So many economic disruptions. And I remember reading story after story in 2020 and 2021 about how COVID had prompted companies to look into captive insurance or beef up their captive insurance.
Absolutely. Right. Yeah, we've formed quite a few captives since COVID, A. And B, I will say this, many of our clients had a loss during COVID, their captive paid. And that was not true in the commercial market. So most businesses that had commercial insurance, they either had a pandemic exclusion in their insurance, so they didn't get any relief, or their insurance only paid if they had property damage, then their business interruption would trigger. Okay. No property damage, no business interruption. Our clients, on the other hand, had policies that were a little more broad. One called broad form property, which triggers if you lose access. So the government saying you can't come to work would be a loss of access. We also had pandemic policies and the like. So during the time of COVID, our captives paid out right about $15 million to businesses that were shut down or interrupted, helped them survive while a lot of their peer companies that they were competing with went out of business. And then when COVID was over, those companies tried to hire their employees back, and their employees are like, no way, Meanwhile, our clients who had a captive and carried it through COVID are now dominating their competitors because they had a captive. Yeah.
And when you own the insurance company, you don't have to worry about the claims department telling you no on your claim.
Yeah, that's exactly right. Yes, right. So back to your IRS question, because we talked about risk and some areas where captives have really shown brightly, and certainly COVID's one of those. The second thing, though, Ed, is you don't have to make the 831B tax election. So many times we talk to business owners and they say, I really want a captive and I really want to protect my business, and I think I can save money on my general liability or my property, but I don't want IRS scrutiny. No problem. You can elect 831A, be taxed exactly the way State Farm is, or the way that Western Southern or any other insurance company is. And so you're able to defer tax by reserving and then invest your money just like they do. And then when you can't justify those reserves, then you take underwriting profit and be taxed at 21%. So it's still a huge win. Mm-hmm. And you really are able to largely sidestep any scrutiny that we're aware of. I'm not aware of the IRS auditing any captive electing 831A probably since about 2014, I believe, when the Rent-A-Center case was. I haven't seen one since. And that's not to say that there is not one, but I haven't seen one since then. So that's another option. And then finally, we do believe, what your point was, that when these rulings come out, then there are good captive managers adjust, right? And we've been doing that. We've adjusted our structure. We've had the actuaries under closer scrutiny, certainly work with onshore U.S. regulators. A lot of captives the IRS has been able to beat were licensed offshore. Really, pretty much all the captives that we manage are onshore. So you have a Department of Insurance regulator from the state looking over your shoulder, making sure that in their eyes you're running a real insurance company, and that's important. So I think there's a lot of things that good captive managers, ourselves included, do to learn from court cases, make sure that they're as defensible as possible. And I'll give you a real quick example. When the IRS first did Notice 2016-66, they noticed a lot of captives had no claims, right? So, and what we saw after that notice.
Let's back up a step.
Oh, yeah.
Explain what that notice was.
Yeah, absolutely. And I was going to come back around to that, but I'll hit it real quick. So Notice 2016-66 was a notice that basically said that captives electing 831B were, without a really high claims rate, super high, were a transaction of interest and had all these reporting requirements. Incidentally, we sued the IRS in 2017, and our lawsuit meandered its way all the way to the Supreme Court, where their notice was, in fact, their use of what was called the Anti-Injunction Act to defend themselves, so to speak, from any pushback. It was thrown out by the Supreme Court. And
that was a 9-0.
9-0, yeah, at the U.S. Supreme Court, yeah.
You couldn't get 9 justices to agree that ice cream tastes good, because Gorsuch is going to say, if it's not rum raisin, I don't want it. And Clarence Thomas loves cookies and cream. And, John Roberts doesn't eat ice cream, but he throws in he says, oh, well, what about custard? What about gelato? Yeah, a 9-0 decision.
9-0.
He's pretty impressive.
And we were very pleased. And then it was remanded back to the lower court, who threw out Notice 2016-66 as arbitrary and capricious. Mm-hmm. Now, when a judge says that your your notice is arbitrary and capricious, that's code for you're a jerk.
Right, you're full of it.
Yeah. So we were pleased with that as well. So I think in our experience, there's definitely benefit to pushing back on the IRS. However, during 2016-66, they gathered all this data, and we noticed a lessening of audits for our clients, and I think the reason is that they do have claims. I mean, our clients, we have noticed that because of the way that we educate them, when they have a loss, they file a claim. And so we noticed that, there were a lot of audits, but I think the IRS found, probably some large swaths of captives that just had no claims. And so that made it much easier for them to target who they're going to go after. And so I think that's the case here as well. Yeah.
Okay. What about a new breed of quasi-captive arrangements where there is no 831B election. You're paying premiums to a commercial insurance company, and then the commercial insurance company establishes a reinsurance cell for you. That kind of a hybrid where you're paying 831A premiums, but you still get a cell where you can invest those proceeds for yourself.
Yeah, that's a good question. So many captive structures are sort of similar to what you described. And we do very much the same thing. So we have what I would call a excess surplus fronting carrier. Ours happens to be in the state of Utah, and it issues insurance coverages, and it writes a wide range of everything from property to general liability to reputation damage, supply chain risk, pretty wide range of risks that it's writing. And then it does, in fact, reinsure after sharing risk with everybody, frankly, reinsures that risk out to incorporated cell insurance companies. And the business owner can elect, our fronting carrier does elect 831A. It's too big to elect 831B. Right. And then the individual cells can decide their own tax election. And I think it's important. We don't encourage A or B tax election, right? So we want business owners to talk to their tax advisor and decide if they want to elect 831A or B, if they qualify for 831B, and then they can make that decision without us advising them either way. Yeah.
Wow.
Which again emphasizes that you guys are not in the tax business. You guys are in the risk management business.
Exactly. Yeah, that's exactly right.
What other sort of coverages should business owners be rolling around in their head? We've talked about some of them, but not really in depth. So tariffs, that's a function of regulatory change because that's a U.S. government action, or would that be covered under, I guess that wouldn't be a supply chain interruption. COVID would be supply chain interruption when the boats were parked offshore of Los Angeles and couldn't unload for months at a time.
That would be supply chain interruption. Certainly, if we had a war in the Pacific, you'd probably see a really big supply chain interruption, right?
Sure. Or if there's a war in Iran.
Even in Iran, absolutely. So supply chain interruptions very real. I think right now things that are very relevant would be receivables, right? So, the economy is a little bit uncertain, I think, and if we see a 2008 style downturn, it will likely wipe out some bit. There are some businesses that are fragile, and they're one bad day away from not paying their bills, right? And maybe they owe you a lot of money. So receivables insurance right now is we call it credit risk or trade risk. That's something definitely worth considering for a business owner. Another one that we see a lot, especially in tech companies, is loss of key employees. So you could not insure that with, Jake at State Farm, right? but you can.
The guy who's in charge of designing your LLM model leaves.
Yeah.
You're toast.
Yeah. So businesses rely on key people. Could be your top sales reps, could be your finance group, could be everybody structuring your process. Losing them can really hurt your business, including having intellectual property walk out the door, even go to a competitor, right? So that's something that we see regularly is realizing people are one of your top resources, insuring them, right? And ensuring the loss of key employees. So that's one that we recommend. Administrative actions, that would be a government agency bringing action against you. And in a lot of settings, we write a lot of pollution coverage for businesses because, pollution coverage is very expensive in the commercial market. It's very unlikely to have a pollution loss, but if you do, it's really big. So, we do see a lot of pollution. And then we do a lot of things to kind of chip away at the margins of commercial insurance. So let's say, I'll give you an example. We had a security company, and they had to have a $5 million general liability policy to have the contracts that they have, right? And that policy was extremely expensive. Mm-hmm. Well, they went and negotiated a whole lot of exclusions in their GL policy. So, the policy was, if you will, there's a whole lot of instances where the carrier won't pay. We insure
Swiss cheese policy.
Swiss cheese, yeah. So it is $5 million at GL, but there's a lot of places that won't pay. We insured all those exclusions in the captive,
Okay.
And frankly, for them, it was about a $300,000 a year savings. Now, if they don't have losses that hit those, they're going to come out way ahead. So that would give you a kind of an unusual example. Yeah.
So it's like paying for insurance, and if you don't have a claim, you get the premium back.
You basically keep all of it. That's right.
Mm-hmm. So that's a really attractive proposition. Let's talk a little bit about who that is appropriate for, because business owners might be listening to this podcast right now and thinking, this sounds great. Now, are they big enough? Are they too big? Who is an appropriate candidate in terms of just, what sort of businesses are you looking for that make the best clients?
Yeah, that's a really good question. And I'm always afraid that when I give this answer, I'm going to scare somebody off that's a great candidate. So
okay.
I would, but I would preface my answer by saying, if you've got several $1,000,000 a year of gross revenue, so let's call it 5 million or more gross revenue, okay, and you've got some free cash flow, or you're paying a lot in insurance, one of the two, you've got free cash flow or you're paying a ton in insurance, there's a good chance that owning your own insurance company is going to be a win for you. So I'll talk about some of the larger industries we see. We have a lot in construction. We have a lot in manufacturing. We have a lot in import-export distribution. We have a lot of medical groups. We have quite a few professional services firms, largely for that people component. Losing people is their big hit. We have a lot of tech companies for the very same reason, losing people, intellectual property defense and theft, very hard to insure, but they're able to do so on a captive. So those are some of the businesses that we see utilizing captives a lot. There are others that, surprise you. I mean, I've got, a candle maker. I guess that would fall under manufacturing, but, who would think that candles, right? Apparel businesses, retail. Interestingly, we've seen a shift for us. We've picked up quite a few clients that, all their sales are on internet platforms, right? So TikTok and Amazon and their biggest risk is getting kicked off or those channels getting shut down. And I'll give you two examples that happened recently. I mean, one client that Amazon decided that they were making some claims they couldn't support, kicked them off the platform. So the revenue went to zero for a while. They had to do the scramble to show all the science behind the claims they were making, filing Amazon, put them back on. Okay. So that's a big hit. And another client does a lot of sales on TikTok. And for a moment there, it looked like TikTok was going away. So they were terrified.
Yes.
So yeah, ensuring your sales channels is a very natural coverage as well. So.
Okay. Who is not a candidate for captive insurance? Is there anyone that just doesn't work?
Yeah, we always joke that, a day trader that sits at home in their underwear and makes a lot of money probably is not a good candidate. So. Okay. So I think if you're running a business that doesn't have a lot of operational risk, for example, then it's even though you could theoretically buy insurance, it likely won't cost enough to offset what you're paying to run the insurance company. So typically a well-run insurance company is going to cost $35,000 to say $100,000, give or take, depending how big it is to operate, because of all the things that go into it: a tax, audit, underwriting, legal, policy issuance, regulatory filings, bookkeeping. So that they're not as easy as just starting up an LLC. They definitely have some work that goes into them. So you need to have enough premium to justify the operating cost.
I got it. Yeah. This is one question I have, Ed. That I've heard people talk about captive insurance as a business opportunity as well. Not just paying the premiums and using an insurance, but also bringing on other people. Do you see that sometimes where they're insuring other people and making it more of a business where it's a good tax write-off now, but later it's a profit generator for them?
Yeah, very good point. We do, absolutely. So there's some keys to doing that, right? So for a captive to be a captive, it has to have what's called a nexus. Nexus is some type of business relationship that justifies insuring, call it a third party, right? So I'll give you a couple examples. If you are a franchisor, you could have your franchisees buy all their coverage from you. That would be very clear nexus because you have a very clear business purpose, right? Another might be, you have a physician practice, but then they have a lot of 1099 contractor physicians. The practice has a captive, issues med mal to everybody that works under their brand, if you will, and instead of having them go buy insurance somewhere else and then run it as a profit center. So as long as there's a reasonable nexus, that's possible. The other alternative, of course, would be, as your insurance company grows, go and essentially, rather than be a captive, go to the Department of Insurance and just apply to be a regular commercial carrier, because now you have enough reserves and they approve you, and now you can write to third parties. So you could certainly grow into it, right? But normally the way to start is related coverage. And there's a lot of really interesting ways to do that. I'll give you another example. We have several of our clients are property casualty insurance brokerages, okay? And they do what's called an agency captive. So they own an insurance company. And imagine if you sold $10 million of premium from one insurance carrier. Let's say it's Cincinnati Insurance, right? And they write $10 million of property premium for you. And you go to Cincinnati and say, I want you to reinsure, and of course they have to negotiate this, but reinsure 10% of that to my captive. So I'm going to participate in the risk. It's a win-win in a lot of ways, because the broker's incentivized to make sure they write good risk. They won't have a lot of claims. The carrier gets that corresponding benefit, but also the broker's able to own an insurance company, participate in the risk of everybody they sell insurance to.
Okay.
And it's a huge win.
Right. So they're not just earning commission income from selling from brokering the policies. They're actually collecting part of the premium income and profit.
Exactly. And so, if you're taking 10% of the risk, you take 10% of the losses, right? So you could lose, but most likely over time you won't if it's underwritten correctly.
Well, insurance companies don't make their money on the risk, is my understanding. They make it investing the back end.
There you go. Right. Yeah, very good point.
Okay. This is fascinating stuff. And one of the things that I like about it is that it is not a cookie cutter. You cannot go to captiveinsurance.com and form your own captive insurance company the way you can go to LegalZoom.com and form an LLC. So they need a company who is expert in the field. So before we wind down the conversation, tell us how Lyon Share listeners can get in touch with you and your company.
Yeah, thank you, Ed. I'd be honored to speak with you if you'd like to learn more about owning your own insurance company, protecting your business, and keeping a lot more profit. So you can reach me on my cell phone, 865-599-6104. It's better to text me, and then I'll call you, or I'll text you. But I get so many spam calls, I can't pick up on no numbers anymore. So shoot me a text first, and say, I heard you on the Lyon Share. That's right.
Yeah,
or you can email me.
Won't take calls if the number's not already in the phone.
Yeah. And you can email me, Randy, Randy, at CIC Services LLC.com.
And what's your website?
Yeah, our website is www.cicservicesllc.com. Don't forget the LLC. A lot of people type in CIC Services and they don't get us. So,
so remember the LLC and
remember the LLC. That's right.
Okay. The world is a dangerous place. It's full of risks, and if you can mitigate your risk and save some money at the same time, you're killing two big fat birds with one stone. So, Randy, thanks so much for joining us. This is the first in a series of discussions we'll have on specific strategies. I can't think of anybody better to have started off with.
Absolutely.
Pleasure. Thanks for inviting me. I really enjoyed it.
All right. It was great. All right. Remember to like and share this podcast to everyone. You're not going to get many podcasts out there that are going to tell you the straight truth. They're going to give you this, this is how you do it. You kind of explained exactly how it's done. That's like and share and write an Apple podcast review for the Lyon Share Podcast. Appreciate it, guys. That was a special simulcast of the Neil Haley Show and the Lyon Share Podcast, guys. Take care.